in lifetime, and one of the best speaker on taxation law today, Sri Ajay Vohra, to this webinar. Honorable Sir, Sri Ajay Vohra is going to speak on analysis of new section 9B and amendment to section 45(4) of the Income Tax Act 1961. I am sure his deliberation on the subject shall clear the wave of doubts and uncertainty on various aspects on tax which has been brought in by these two new enactments. There is lots of doubts about the overlapping of these two provisions. Our today's speaker and senior advocate will positively clear all these doubts to the satisfaction of the entire audience. With these words, I inaugurate today's webinar and hand over the mic back to Siddhartha Rai. Thank you.
Thank you, Mr. President. I would now request Sri Siddhartha Mukhopadhyay, Honorable Vice Chairman of the Bar Council of West Bengal and the General Secretary of Tax Advocates Association of Bengal, to be formally there along with the President of ITBA. He has already inaugurated, so we would like to have the address of Sri Siddhartha Mukhopadhyay on behalf of TAAB, so that it is also formally inaugurated from their part. Thank you. Siddhartha.
Thank you, Siddhartha. This webinar is organized by two renowned associations of tax advocates in West Bengal, namely Tax Advocates Association of Bengal, TAAB, and Income Tax Bar Association, ITBA. Today's topic is analysis of new section 9B and 45(4) of the IT Act 1961. The viewers are very much eager to hear the learned speaker, senior advocate of Supreme Court of India, Sri Ajay Vohra. The General Secretary of ITBA will introduce him after this inaugural speech. We are glad to have with us learned advocate Sri S.K. Tulsian, President of TAAB and former President of ITBA, as a moderator to this webinar. I am sure that the viewers will acquire knowledge from this webinar, which ultimately help them in their professional field. My regards to Sri Ajay Vohra, Sri S.K. Tulsian, Sri Makhon Haldar, President of ITBA, and best wishes to Manoj Kataruka, Siddhartha Rai, and all the members present today at this webinar. As our President of ITBA inaugurate this webinar, I request Sri Manoj Kataruka to introduce today's learned speaker. Siddhartha Rai, please.
Yes, as my namesake and senior Siddhartha has already done the honors, Manoj, if you could please carry on with the introduction of Sri Vohra.
Thank you, Siddharth. Mr. Ajay Vohra, a qualified chartered accountant and lawyer, and has been practicing since last 36 years in the area of domestic and international tax laws, and is a leading arguing counsel before the tax tribunals, high courts, and the Supreme Court. He has argued several cases involving complex issues having wide ramifications, which has contributed immensely to the tax jurisprudence in the country. Prior to being designated as senior advocate by the Delhi High Court in September 2014, Mr. Vohra was the managing partner of Vesh Associates Advocates, a leading law firm from 2006 to 2014. Mr. Vohra has been rated as one of the most highly acclaimed legal experts in the Asia Pacific region in the field of taxation by the Asia Law Leading Lawyers Guide, for each of the years 2006 to 2014, prior to his designation as senior advocate. The Legal 500 has inducted him into the Hall of Fame for Asia Pacific for having been recommended as leading individual with tax for 13 consecutive years. Mr. Vohra has been regularly contributing articles in various journals and addressing seminars nationally and internationally. He has been the past chairman of International Fiscal Association, India branch, past chairman of the Direct Taxes Committee of the PhD Chamber of Commerce and Industry, as also member of the managing committee uninterruptedly for several years, vice chair of the Tax Law Committee of the International Pacific Bar Association. Mr. Vohra has also served on the board of several large corporates. Thank you, and I hand over back the proceedings to Siddharth.
Thank you, Manoj, and the moment has arrived. So the audience is eager to listen to and get enlightened with Sri Ajay Vohra's deliberations today. Sir, before that, I would request Sri Sajjan Kumar Tulsian, who would be moderating the show, to please initiate the process from here. Thank you.
Welcome to today's webinar. Our honorable speaker, learned Sri Ajay Vohra, the senior advocate of Supreme Court. Our president, Makhan Chand Haldar, vice chairman of the Bar Council of West Bengal. Both have welcomed him, and it is a matter of joy that we have got large participant to hear him today on a subject which is of foremost importance both to the tax practitioners and to the assessees. Now, the issue on which today's webinar is that introduction of new section 9B and substitution of section 45(4). Section 9B recognizes a new concept of taxation of the capital asset or stock in trade, which is transferred to a partner, outgoing partner, or in the reconstitution of the partnership, or to the partners on the dissolution of the partnership, thereby creating a fiction of deemed income on the basis of fair market value of the asset being transferred, deemed transfer to such outgoing partners or to the continuing partners, and thereby fixing that either as business income under section 28 or under section 45(1). Simultaneously, the provision of section 45(4) has been enacted, whereupon through the process of attribution, the capital gain is being charged independent of the provision of section 9B in the hands of the firm, and therefore it needs lots of explanations to clear the way as to how that attribution will be made with reference to the existing assets, whereupon at the time of the disposal, sale of those assets, what effect of such attribution will take place with reference to section 48(3) of the Income Tax Act. I would also request him to explain the board circular issued on 2nd of July, wherein through the various examples, this process of attribution has been explained in the board circular, and thereupon clear the way which is existing still in the minds of the people, and there cannot be no better person than him to clear all these waves. So I welcome him to this webinar, and I request him to deliver his speech. Thank you. Sri Ajay Vohra.
Thank you, Tulsian Saab, for giving me this opportunity to be in your midst this afternoon. Mr. Haldar, President of the Income Tax Bar Association, Calcutta, Mr. Mukhopadhyay, Vice Chairman, Bar Council of West Bengal and Secretary of the Tax Advocates Association, Bengal, and the office bearers of the two associations who have organized today's webinar. My greetings to the audience who's gathered here to hear this webinar. I think when Mr. Tulsian approached me, I thought this was a subject which is of topical importance today, and this has been defined as, according to me, a watershed moment in the taxation on reconstitution of partnership firms, LLPs, association of persons, or body of individuals. Now, unknown to many, the Finance Act 2021 has made these changes by introducing new section 9B, which Mr. Tulsian alluded to, and substituting section 45(4). But most importantly, I think, I don't know how many people have noticed that these amendments are retrospective. They are applicable from 1/4/20, that is, they are applicable for the assessment year 21-22. Normally, provisions in a Finance Act are applicable only from the next assessment year. So, reconstitution of partnerships which have already taken place during the financial year 2021 are to suffer this tax, which was not on the statute at the time when the reconstitution was taken. So, this is also being debated in some circles whether the amendment that has been made by introduction of section 9B and substitution of section 45(4), at least to the extent of the retrospective effect, whether that should be challenged in a court of law. So that I will leave for the time being, but as a consequence of these amendments, tax has become payable on reconstitution of firms that has taken place during the financial year 2021. Having said that, I think I'll request Siddharth. I have sent a presentation to the Bar Association
Sir, it's ready.
For the benefit of the participants, which will probably help understanding of this complex subject. So we can come to slide number, the next one. I think move on. So old section 45(4), we can go to the next slide, Siddharth. Old section 45(4) provided that on dissolution of the partnership firm and distribution of capital asset to its partners, the gains would be taxable in the hands of the firm. Now, if you recall, the controversy was that this section applied only in the case of dissolution of the firm or otherwise. Now, the words otherwise was a matter of interpretation, connotation, whether it will include a case of retirement. So if there was distribution of capital assets on dissolution of the firm, I'll take a simpler situation. Then in that situation, the fair value of the assets was taken into consideration and capital gains computed in the hands of the firm. But when a partner receives money standing to his credit or monies in excess of the amount standing to the credit of his capital account, the courts had taken a position that there is no incidence of taxation in the hands of the partner. So this was the position under the erstwhile section 45(4). Now we'll move on to the next slide. I think I've just covered this dealing with the old position. Now this is the new regime under section 9B and the substituted section 45(4). We come to the next slide, which sets out the parameters of attracting section 9B. Next slide, please. So it is applicable on dissolution or reconstitution of the firm. It is applicable, as Mr. Tulsian pointed out, when there is distribution of a capital asset or stock in trade by the firm to a partner. I'm for simplicity's sake dealing only with a partnership firm. Now here kindly note that this does not apply to distribution of money by the firm to the partner. It applies to a capital asset or stock in trade. The tax is in the hands of the firm by deeming this distribution to be in the nature of transfer and has consequences in terms of the applicable provisions of law. If it is transfer of a capital asset, the provisions in section 45 will kick in relating to computation of income under the head capital gains. If it is distribution of stock in trade, then the provision relating to profits and gains of business would kick in. The year of taxability will be the year of receipt of asset by the partner. Heads of income I have explained, and the consideration will be the fair market value of the assets. Now just stopping here, when we look at the fair market value, the question that can arise is, for instance, if an immovable property is transferred by the firm to a partner, the provisions of section 50C will kick in. So when you look at the FMB, you need to take into account all the applicable provisions that deal with computation of income under that particular head. Next slide, please, Siddharth. The section defines reconstitution to mean cases where one or more of the partner retires, or one or more of new partners are admitted with at least one existing partner continuing the firm, or there is change in the share of the existing partners. So inter se change in partnership ratio, induction of new partner, retirement of existing partners will all be considered as reconstitution of the firm. And if there is distribution of capital assets, stock in trade, then in that situation, there will be tax incidence in the hands of the firm. Now, importantly, while this section was introduced by the Finance Act 2021, there were no guidelines provided as to the manner of computation. There were no provisions dealing with how this actually needs to be computed in actual practice. So these, we have subsequently got new rule 8AC, which will come to, and the board circular that Mr. Tulsian mentioned. Now we come to section 45.4. Next slide, please. Section 45.4 also applies in the case of reconstitution of the firm. So both 9B and 45.4, and the president of our association mentioned about the overlapping impact of the two sections. Yes, in a manner of speaking, since both sections apply on reconstitution of firm, there is an overlap between the two provisions. Again, this section is applicable on receipt of capital asset and or money. Significantly, it does not apply to transfer of stock in trade. So importantly, while 9B deals with capital asset stock in trade, section 45.4 only deals with distribution of capital asset. Again, the tax is in the hands of the firm. The year of taxability remains the same, year of receipt by the partner. The head of income in the hands of the firm is income under the head capital gains in terms of section 45. Importantly, the section clarifies that this tax under section 45.4 will be in addition to the tax under section 9B. So there is an overlap to that extent that both the taxes will become applicable on the firm. So the computation mechanism is that the fair market value of the capital asset plus money that is paid to the outgoing partner, if it is in excess of the money standing to the credit of the capital account of the partner, the same is brought to tax under section 45.4 in terms of the prescribed formula. So if you move on to the next slide where the formula is given. Next slide, please. Yes. The formula, no. I think we go back one slide. Yes. The formula that is given is A is equal to B plus C minus D, where A is the capital gains chargeable to tax, and therefore we need to determine this amount of A. Importantly, this cannot result in a capital loss. So if A is negative, it is taken as nil. B is the value of money received by the outgoing partner. C is the fair market value of the capital asset received. And D is the balance in the capital account of the partner. And here, importantly, you ignore the effect of any revaluation taken in the past with respect to any asset, any recognition of self-generated goodwill or assets in the books of the partnership firm, which is credited to the capital account of the partner, needs to be ignored. So basically, money standing to the capital account of the partner as decreased by any notional increase or any upside on account of revaluation of assets or on account of recognition of self-generated assets is to be removed from the balance to the credit of the partner in the capital account. Earlier, as you are well aware, companies or firms would revalue, let us say, immobile property, valuable land was revalued, and the amount of revaluation was credited to the capital account of the partners, which the partners withdrew at the time of leaving the firm. And there was a new partner who came in who brought the equivalent amount of cash. So the partner moved out without any tax incidence. That was the kind of tax planning that was happening in the past, which has been nipped in the bud with respect to this amendment in law. So the next slide, please. The next slide gives a comparison. gives a comparison between section 9B versus section 45(4), which I have dealt in detail, but just pointing this out. 9B applies to distribution of all kinds of asset, capital asset as also stock in trade. 45(4) applies only in a situation of distribution of capital asset. So both apply in the case of dissolution or reconstitution. Then transfer of stock in trade, as I pointed out, is not covered. The computation mechanism in 9B is to take into account the fair market value of the capital asset stock in trade that is paid out to the partner. In terms of section 45(4), the capital gains are computed in terms of the prescribed formula, but clearly you also need to take into account the fair market value. In terms of 9B, you can have a capital loss stroke business loss on distribution of asset to the partner. That computation in section 45(4) as per the prescribed formula cannot result in a loss. Now, whatever tax is paid under 9B is not attributed, not allocated, whereas the tax that is paid or the gains that are computed in terms of section 45(4) are distributed in terms of section 48 Roman 3 and read with rule 8AB, which has just been introduced with effect from 7th of July 2021. So between the time that the Finance Act received the assent of the President, which is sometime toward the end of March, till July, you had no rules explaining how the mechanism is to be put in place. The next slide. This points out the overlap between the two provisions. 9B 45(4) apply both in the case of reconstitution. 9B applies on dissolution, whereas 45(4) does not. 9B, as I mentioned, does not apply to distribution of cash or payment of cash to the partner. The same is covered under 45(4). Capital asset distribution is covered under both sections, but stock in trade given out to the outgoing partner is only covered within the purview of section 9B and not under 45(4). Section 48(3) provides a kind of succor in order to reduce the incidence of taxation in a later year, which is the tax paid on capital gains computed in terms of section 45(4) and which is illustrated in the circular and the rule that has been enacted subsequently. This amendment provides that the amount of capital gains offered to tax by the firm under section 45(4) shall be allowed as deduction while computing capital gains on transfer of any remaining capital asset by the firm in future in the manner to be prescribed, and we will come to the rules and the examples. So this seeks to ensure, although in the year of distribution, tax will be paid both under section 9B as also under section 45(4), there may be a double incidence to that extent. But in a later year, the capital gains that were computed under 45(4) will be added to the cost of the remaining assets, and to that extent in the future there may be a lower incidence of tax on transfer of a capital asset. So we will then look at rule 8AB. Now this rule, yes, we can come to the next rule 8AB. Next slide, please. So the rule also is fairly complex, not easy to understand. It says that the income under section 45(4) is attributed to the remaining capital assets of the firm, and then the capital assets that remain, if this income, it says, relates to revaluation of capital asset or valuation of self-generated asset or goodwill of the firm, then there is a formula prescribed, which is the amount attributable is treated as the amount charged to tax under section 45(4) into revalued amount over the aggregate amount of revaluation of all the remaining assets. So as per this formula, you need to take into account the revaluation of an asset and the income that is attributed under section 45(4) is allocated over the remaining assets as per this formula. If the income under 45(4) only relates to capital asset received by the specified person, there is no attribution. The double incidence of tax remains for all times to come. Then if this income does not relate to revaluation of capital asset, self-generated asset, goodwill, again there is no attribution. So only in a situation where the income is as a result of revaluation of capital asset or valuation of self-generated asset or goodwill of the firm, it is allocated over the remaining assets. So let us come to the next slide. Now, this amount that is to be allocated has to be decided basis a certificate from a registered valuer as defined in Rule 11U. And then the amount that you attribute must in the year of distribution be notified in the return and the form 5C that is to be filed along with the return for the year in which tax is charged under section 45(4). So this is an important requirement of filing form 5C on the basis of which you would allocate this income under section 45(4) in the specified circumstances to the remaining assets of the firm. Again, the rule provides that no depreciation shall be allowable to the specified entity on revaluation of existing assets or valuation of self-generated assets or goodwill or on the amount attributed. So the gains that can be taxed would be allocated both towards depreciable as also non-depreciable capital assets, which we will see with reference to the circular. And when there is disposal of a depreciable asset, since the computation mechanism is provided in section 50, that will be taken into account for determination of short-term capital gains that arise in case the block ceases to exist. So it will be reduced from the written on value of the block at the time of future sale, basis the allocation of the income that on which tax is paid under section 45(4). The next slide. Now, what is the nature of gain that is to be taxed under section 45(4)? Is it long-term gains or short-term gains? Frankly, until this rule came in, one was at a loss of what should be the quantum of tax that should be payable under 45(4). And I had taken a position that since the income of the firm is subject to tax at 30%, that's the amount of tax, because there was no basis to determine whether this is long-term or short-term. There was a view gaining ground that if a partner has remained in the firm for more than 3 years, then the gain should be long-term and therefore the tax rate should be lower. All those controversies, views have been put at rest by this amendment made in the law, which now prescribes whether the gain will be short-term or long-term. So Rule 8AA5 provides for the nature of gains. Just one second. This will be in the nature of short-term capital gains if the gain is attributed to short-term capital asset at the time of taxation, capital asset forming part of the block of assets, or self-generated asset or goodwill. So in that situation, the gains will be of the nature of short-term capital gains. This will be in the nature of long-term capital gains if the asset is not of the nature described in the previous block or is long-term capital asset at the time of taxation. So the rate of tax will accordingly vary depending upon whether the gain is short-term or long-term in nature. We can come to the next slide, which is the illustrations given in circular number 14 of 2021. Next slide, please. This is the first example that has been given, where if you see the partner's capital balance is shown as 10 lakhs each for A, B, and C. Now the capital assets, that is land, the fair market value on the date of distribution or reconstitution is 70 lakhs for land S, similarly 70 lakhs for land T, and land U is 50 lakhs. Now the facts stated are that all the three lands were acquired by the firm more than 2 years ago and are thus long-term capital assets. Now A is seeking to retire from the firm, and the facts state that on retirement of A, the lands are revalued and the FMV is determined basis valuation report of the registered valuer. What is important is this revaluation is not recorded in the books. This amount is not credited to the capital account of the partner, but the fair value or the revalued amount is determined on the date of distribution. Now the firm decides to give A 11 lakhs of money and land of valuing 50 lakhs on retirement. The index cost of land is stated to be 15 lakhs and the flat rate of tax at 20% on long-term capital gains. Now kindly see this example continues in the next slide. The income that is computed under section 9B with respect to the distribution of land, the fair market value of land is taken at 50 lakhs, index cost of acquisition at 15 lakhs. So there is long-term capital gains on the transfer of land U to the retiring partner at 35. The tax payable on long-term capital gains in the hand of the firm at 35 at 20% is 7. So the law further provides that in the hands of partner A, the outgoing partner, whenever he subsequently sells, the cost of acquisition of the land will be 50 lakhs. Now, in this example, the computation under 45(4) is illustrated in this slide. So, the net profit on deemed transfer of land U to be credited to partner's capital account. So, this 50 is shown as the revalued amount of land U. The book value of this land is 10 as per the example. The book profit before tax is 40. Tax payable on the long-term gains in terms of 9B is 7. Net book profit to be shared in the profit sharing ratio is 33. So thus capital of each of the partners will be credited with 11 lakhs for the profit as calculated above on the basis of revaluation of land U valuing 50 lakhs. Then the next slide. Now the capital account of the partners as revised and the capital gains computation under 45(4) is given here. Capital balances as per the books of accounts is 10 each. Book profit on deemed transfer as calculated in the earlier slide, 11 is credited to each of the partners. Total capital balance as per the books is 21 for each of the partners. Money given to A is 11 lakhs in cash plus this land of 50, valuing 50. So excess amount that is paid to outgoing partner A is 40 in excess of the balance in his capital account. 61 minus 21 comes to a figure of 40. Next slide, please. Now this excess money, which is the amount of 40 lakhs on which tax would be paid, this will be charged to tax under section 45(4) in addition to 35 lakhs charged to tax under section 9B. Now this 40 lakhs is to be attributed to the remaining assets of the firm on the basis of the increase in their value due to revaluation. So as we saw, the value of land remaining with the firm S&T has increased from 10 lakhs to 70 lakhs. The fair market value on the date of distribution of both land S&T is 70 lakhs. So the upside is from 10 to 70, which is in the ratio of 60-60. So this 40 is divided in the ratio of 60-60, or let us say 1:1 between the two assets. So 20 lakhs is attributed to each of the two assets, land S and land T, and this will have to be depicted in form 5C that is filed along with the return of income. So in future, when land S or land T is sold, this 20 lakhs will be reduced from the sale consideration. So this is the impact of section 48(3) and the mitigation that is provided under the said section in order to reduce the double incidence of tax. So this is so far as this example 1 is concerned. Tulsian Saab, what is your suggestion? Should I stop here to take questions or should we move forward and deal with all the examples?
I have a question.
Right, sir.
I have a question.
Yes, sir.
My point is that the example says that there are two remaining capital assets in the partnership firm. So the gain will be attributed to these two remaining capital assets.
Right.
But say there is no capital asset.
No, then
Where this gain will be attributed?
Then
it means there will be complete double taxation.
Yes.
There will be complete double taxation. So it means there some will be the beneficiary only because they have capital asset. Others will not be because they don't have the capital asset. Right. So where is the question of equality in taxation? Will it not be hit by Article 14 of the Constitution?
No, this is certainly a thought, worth pondering over. You are absolutely correct that if there is no capital asset with the firm, there will be this permanent outflow of tax, which will not be mitigated in the future.
Yes.
But if you have a remaining capital asset, then as you very rightly said, this will be attributed to the remaining capital assets and adjusted when it's sold in future.
Yes.
To this extent, you are treating equals unequally.
Yes.
The situation is the same. It is reconstitution of the partnership firm. One partnership firm has capital assets, one does not have a capital asset. The incidence of tax in both situations will be different. It will be same in that year, but going forward, they will be treated differently. They will be discriminated.
No,
Yeah,
now,
your point is well
now
taken.
there is another example where a partnership firm is reconstituted. A new partner comes. He brings in capital, but there is no outgoing partner, and there is no money or asset paid to the remaining partners. In such a situation, the incoming partner will get the share of profit as well as share in the asset without suffering any tax. Whereas if one asset is given to, or some stock in trade is given to the remaining partner, then that shall be charged to tax. So in this situation also, a person say firm has got 4 lakh rupees capital, but the value of the asset is 1 crore rupees. A new partner comes in, he brings in 2 lakh rupees of capital. He is given 50% share. He acquires 50% interest in the property also. So by contributing 2 lakh, he is getting value of the property to the extent of 50%, but he is not suffering. The firm is not suffering any tax. Partner is not suffering any tax, because section 56 to 10 will also not come into operation.
Right. So I think you've touched on a very good point. The question is, first, when a new partner comes in, brings in 2 lakhs and gets a 50% share in the partnership and the assets of the firm, which includes this valuable property for valuing over 1 crore. Now, the first question I ask myself is, can you say in this situation that the partner has 50% interest in the assets of the firm? My view is, so long as the firm is a going concern, no partner can claim any interest in the assets of the firm. But if the firm is dissolved, the partner gets the 50%. So,
but all of them have got undefined share. He is placed in the same situation as partners. Say there is no asset. Say there is a stock in trade of 2 crore rupees.
Right.
Capital is only 4 lakh rupees. He will be getting share in the profit of the firm equally on that stock in trade.
Right. Whenever it is sold.
No tax is being suffered by the firm. No tax is suffered by the partner.
As you very rightly pointed out, 56 to 10 does not cover interest in a partnership in the definition of property.
Yes.
So therefore, when he brings in 2 lakhs and gets a disproportionate share, to that extent the partner is advantaged.
Yes.
Then the question that can arise is, should this reconstitution not fall foul under GAR?
That is another thing.
But
the situation will still, I am taking it still further.
Right.
Say that new partner has come, taken 50%. After 6 months, the 2 other partners goes out. They take only share of their capital in the partnership firm. They don't get anything.
Right.
So he becomes 100% partner
by
investing only 2 lakh rupees.
Right.
So in this issue has not been addressed either by section 9B or by the amended section 45(4).
But the question will be that the outgoing partners, when they allow a new partner to come in, investing only a piddly sum of 2 lakhs and taking a 50% interest or becoming a 100% owner of the firm, once the two retire and only take the balance standing in their capital account, whether this whole arrangement is sham or collusive.
True. That is another thing. There's a matter of litigation.
Yes.
The law is not addressing it.
Yes, the law is not addressing.
Law is not addressing it.
Yes, I agree with you.
So these are the 2 pertinent questions which I had in my mind. So I thought I shall address it.
But the important point is that the outgoing partner in your examples does not receive any valuable consideration or does not receive any money over and above.
Yes, their capital balance.
He is allowing an outside person to come in
Yes.
and take over the firm or enjoy substantial share in the firm
Yes.
without being benefited in any manner.
Yes. So that may be an issue of guard. That may be an issue of deliberation. That may be an issue of discussion. But these section 9B and section substituted section 45(4).
56 does not take care of this situation. 56 to 10.
So this both attribution and section 9B both are defective.
Right.
Section 45(4) and section 9B both are defective to that extent.
Right. I agree with you.
Sir, there is a question in the chat box, Mr. Tulsian, for your perusal. It is from Mr. Sumit. He is asking that it is seen that to plug the leakage of revenue or to open a new source of revenue, such type of amendment is made. Is there any specific background to make such amendment after 60 years of its enactment?
I think basically, as I would say that people in the North Block are looking at all these kind of tax planning devices that are prevalent. You see, there is substantial, in Mr. Tulsian's example, I think the outgoing partners are the benevolent charitable kinds. But there are others who encash or monetize their interest in the firm. And although the assets in the firm may be a small amount because that's the historical value of the assets, but the real market value of the assets may be substantially higher. Now, if a new partner was to come in, bring in substantial capital in cash, and the outgoing partners were to walk away with a large kitty, much in excess of the balance in their capital account, a question had arisen, and this was agitating the courts, whether the partner can be taxed or the firm can be taxed.
Yes.
Now, the preponderance of view was that there can be no tax incidence in such a situation. So this is to plug that loophole where actually there is a transfer of asset, like you transfer shares of a company holding immovable property. The ownership of the shares changes, the property remains in the company where it remains. Here in this case, the asset continues to be owned by the partnership, but you have a new partner who is now controlling the partnership, who is really enjoying the value of the property, the upside in terms of, like he said, the example of stock in trade, the profit from the sale of the stock in trade. So to address these concerns, I think the government takes time to wake up to these tax planning practices that are currently in vogue. And once they become rampant, in the sense most people tend to exploit these loopholes in the law, that's when the legislature steps in to make corrections and make amendments. So I think that's probably the reason why this has happened. And if you see the Finance Act 2021, I think will be unique in the sense that almost all the amendments are retrospective from 1/4/20.
No, you see, this is against the policy of the government.
Right.
The parliament, in the first year of this government, in the parliament, the government declared they will not make retrospective law. Right. So the Supreme Court has said that if a minister makes a promise, or if a chief minister or the prime minister makes a promise, that has to be adhered to. You cannot take it so lightly. So in the parliament, if the minister of finance has declared that the government policy not to go for the retrospectivity, and all of a sudden they make all the laws retrospective, then would you not say that this retrospectivity at least will be addressed by the court?
I would, sir, Tulsian Saab, say that, this question of whether a retrospective amendment can be embarked upon by the government or by the legislature, I think the courts are leaning more towards upholding the retrospective amendment, notwithstanding the fact that this is not
the declared policy of the government. I'm not saying that the retrospectivity is not permitted.
It's not a promise. I think it's a statement made. It's not a promise. And they would say that, this kind of amendments retrospectively have become necessary in order to plug the loophole in the law.
To all laws amendment are to plug the loophole only.
Right. So I think this is an open question, but I think the courts would lean towards upholding the retrospective amendment.
So there is another question in the chat box from Advocate Mrityunjay Mukhopadhyay. He's asking what will be the treatment in case of death of a partner under these sections, under both the sections.
No, so you see, the question will be that what does the partnership deed provide as the stipulation in the event of death of a partner? Do the legal heirs automatically step in, or is there bound to be a reconstitution of the firm? So the partnership deed will spell that out. Now, assuming that there is a reconstitution and the partner, if the deed provides that the partner is only to be given the balance standing to the credit of the capital account, clearly there will be no incidence. But suppose the deed provides that you will draw up accounts, you will take the fair market value of the assets on the date of the death, and the upside will be given to the partner. So then this will trigger. So there will be a reconstitution because that deceased partner's share will devolve on the remaining partners. So to that extent, there will be an incidence of tax on the firm.
This 9B has been enacted separately as a section. Why not amendment has been made in section 28 and section 45 to address the issue of taxing the stock in trade and the dim transfer directly therein, rather than introducing this machinery provision by way of section 9B, because section 9B is not a taxing provision. Section 9B is a machinery provision, and it has been brought in, and ultimately tax is being charged as business profit or as capital gain. So it is coming under section 28 or under section 45. So therefore, what is the purpose of enacting section 9B independently?
I think this is always interesting to come to this webinar by the Calcutta Association, because one is intellectually challenged by all these queries that are put by Tulsian Saab. My analysis is slightly different.
Yes.
I would not hold section 9B as a machinery provision. You see, the incidence of tax in this situation is on account of two triggering events. One, 9B says that when an asset is distributed to the outgoing partner, it's a deemed transfer by the firm. So transfer in terms of 45 or transfer for purposes of section 28. So that's one taxable event. The second is when the partner receives money in excess of the balance in his capital account.
Yes. That is 45.
Two separate incidences. The only thing is that in both cases, it is the firm which is paying the tax. The tax is on the firm, but these are two separate events. 9B has no relevance to the distribution or the monies in excess paid to the partner in excess of the balance in his capital account. So the mechanism for the two sections is completely different. And 9B is a charging provision, not a machinery provision, so that it could be brought under 28. It is deeming a transfer, and that is the taxable event.
But will the computation of income will take place under section 90, or it shall take under section 45 and section 28?
So 9 takes you back to section 45 or 28 as the case may be.
Yes, because charging provision ultimately will be section 28 and 45.
See, if you see section 9(1), for instance, for applicable to a non-resident. Now in that situation, if it is business income, you go back to 28. If it is income from transfer of a capital asset, you go under section 45. So 9 is basically a charging provision, and then the computation mechanism is as applicable to the head of income.
So there are a few questions on the chat box. Advocate Pavan Kumar Rai wants to know whether there is any relation of section 9B with section 115 TD, special provision relating to tax on accredited of certain institutions.
No.
There is another question from Subroto Rai. When section 247 and it has not been amended, I don't know what exactly he means, but Mr. Kedia wants to know, on dissolution, firm ceases to exist. How the department do the assessment of the firm in the year when partner receives this asset?
No, you see, there is a special provision that there will be an assessment even if the firm is dissolved. I think it is probably section 178 or something. there will be an assessment that will follow. There is a special provision even if you have in 176 discontinued business, then you have association dissolved is 177. So discontinued business is 176.
176. Up to the date of discontinuance.
So this section will take over. So there are provisions in the Act to deal with such a situation. So
We can move to second situation.
let us come to example 2.
Yes.
So Siddharth, can you put up this slide 22? This is example 2.
Yes, this will do, sir. We start from here.
Yes, we can start from here. So here basically instead of the partner taking over the land U, this is sold at 50 lakhs to a third person. And the partner is paid cash of 61 lakhs. So here there is no distribution of capital asset or stock in trade to the partner. He is only paid cash. So section 9B there is no application of section 9B in this case. There is capital gains earned by the firm with respect to sale of land at 50. So this amount will be credited to the capital account of the partners. So if you see here, there is long-term gains of 35 on which long-term capital gain tax of 7 is to be paid. So here basically again the same book profit of 7, 33 is the book profit on sale of land, and that is credited to each of the partners' capital account in the ratio of 1:1. So the partners' capital balance remains the same at 21. Money is given again are 61. So the amount of income taxable under 45(4) is 40. Then this 40 again has to be attributed to the two situations. Here, since land U has gone out and land S and T are again valued at 70 lakhs as opposed to historical cost of 10, the income of 40 lakhs, the capital gains of 40 lakhs is distributed in the same manner, 20-20 between the two assets. So here basically the issue remains the same. So instead of tax being paid under 9B, you are paying tax on capital gains of 35 lakhs on sale of the asset to an outgoing to a third person. Example 3 is, in this example, you have the three partners with capital of 100 lakhs each. You have capital assets, land S, which is in the nature of a long-term capital asset, and where the fair market value is 45 against historical cost of 30. You have a patent which was registered 1 year back and on which depreciation has been claimed, which is shown in the books at 45, and there is the fair market value of which is 60. There is also self-generated goodwill of 30 lakhs, which is there as per the valuation report. Now partner A is retiring. The firm decides to give him 75 lakhs in cash and land S to settle his balances. The index cost of land S is, as per the example, at 45 lakhs and flat tax rate at 20% on long-term gains. So these are simplistic assumptions to make calculations easier. So in this example, the next slide, so under 9B, the computation is the fair market value of land S is 45 lakhs. Index cost of acquisition is also 45 lakhs. This is the example that is taken. So long-term capital gains on deemed transfer of land S is nil. So there is no tax on long-term capital gains in the hands of the firm under section 9B. Then coming to section 45(4), we first calculate the capital balance of partner A. So book value of land assets is 30, against which the fair market value is 45. There is a book profit of 15, which is distributed again in the amongst the partners in the profit sharing ratio. We are on slide 29, Siddharth. So the capital balance in this example is 100 lakh for each of them. The book profit of 15 on deemed transfer is allocated 555 to each of the partners. The total capital balance becomes 105. The money is paid to partner A is 75 lakhs in cash and also land of FMV of 45 lakhs. So he is paid 120 lakhs as against 105 lakhs. So the excess amount is 15, which is the income taxable in terms of section 45(4) as capital gains. Now, the attribution with respect to this amount of 15 lakhs, which is brought to tax under section 45(4), would be amongst the remaining assets. Now, in this example, as you saw, value of patent T has been revalued at 45 lakhs as against book value of 30 lakhs. And self-generated goodwill in the valuer's report, although it is not appearing in the books, self-generated goodwill has been recognized at 30 lakhs. So thus 15 lakhs is to be attributed between patent and self-generated goodwill in the ratio of 15:30, that is 1:2. So patents will get 5 lakhs allocation and 10 lakhs will be attributed to self-generated goodwill. This amount of 15 lakhs is treated as short-term gains, since 5 lakhs is attributed to patent, which is a depreciable asset, and 10 lakhs has been attributed to self-generated goodwill. So in this example, for the first time, this differentiation between short-term capital asset and short-term gains and long-term capital asset is brought out. So this tax will be paid as applicable on short-term capital gains, because the remaining assets are patent and self-generated goodwill. So the example provided just before the previous slide, please. Can we have the previous slide? This 5 lakhs will not be attributed to patent T for purposes of depreciation, as is provided in the rule itself. But when the patent is subsequently transferred, then when you consider the written down value of the block, then in that situation it will be reduced from the full value of the consideration that you receive for transfer of the patent. So this is how the mitigation happens in terms of section 48(3) and in terms of the rule and the examples given by the CBDT in their circulars. So there are still several questions that are open for adjudication. I am sure these matters will travel to the courts, including the constitutional validity of some of the provisions. And it is a matter of time before, the lid can be put and sealed on all these controversies that will abet once this is actually put into practice. So there are still some open issues that remain, which are highlighted on this slide. But I'm sure the participants here also have some questions which have been.
Yes. There are lots of questions on the chat box which needs to be addressed.
Right.
Now come to these chat box. Lata, just be. Lata Goyal. Under sub-rule 5, you can see under sub-rule 5 of Rule 8A, the nature of capital gain, that is whether the short term or long term, arising under section 45(4), is not dependent on nature of the outgoing asset, but will take its color from the nature of the remaining capital asset, to which such capital gain under section 45(4) or part of it is attributed in the manner provided under Rule 8AB. Right. Under the given facts, how will the nature of capital gain be determined for the purpose of section 45(4) read with Rule 8AA, when the firm has no remaining capital asset to which the capital gain arising in 45(4). It is the same which I think.
I think the point that you made, Tulsian Saab, which I have shown in the slide, that if there is no remaining capital asset, there is no attribution.
No, true.
If you just see this slide number 13, if you can just put up this slide 13. Siddharth, put up slide 13 if you can.
Slide 13.
So here if you see,
Yes.
if there is no remaining capital asset, then in that situation there is no attribution.
Yes. So there is a money. Some will be benefits, some will not be. That of course is an issue which has to be.
Right.
Now come there is a Kornika. Kornika also has raised a question. Come to the Kornika's question. Kornika's question come. Kornika. In case of reconstitution of a firm pursuant to change in the profit sharing ratio, where a partner A receives certain capital asset, say having gained a fair market of 10 lakh from the firm, in lieu of reduction in his future share of profit, say reduced from 50 to 35%, Section 9B and Section 45(4) are clearly attracted. In such a situation, how will the capital gain under Section 45(4) be computed? That is of course already addressed.
Right.
This you have already addressed. Then come to next chat. This is from Mrityunjay Mukhopadhyay. How goodwill will be valued and treated as reconstitution in the case of outgoing incoming partner? Is it only provision, deed, or otherwise? Goodwill, of course, everything has to be done through the registered valuer only.
But again, this question about valuation, I don't know whether this will get into litigation.
Yeah, that of course.
Of course, the company today, since goodwill is no longer a depreciable asset, and there is no fun in allocating amount to goodwill, I don't think firms will like to, in the valuer's report, attribute major amount to goodwill.
Correct.
This will be a dead loss.
There is another question from Laksha Buddhi Raja. He says a new partner is inducted in existing firm, contributing capital equivalent to the existing partner with share of 50% in the profit from partnership firm. The total capital contribution is 6 lakh, that is 3 lakh contributed by the incoming partner, 3 lakh existing partner. Firm has a loan outstanding of 67 lakh. Firm owns an asset, that is inventory. The fair market value is 2.5 crore. Book value is 70 lakh. In this case, no stock in trade or capital asset is transferred in favor of any of the partners. What will be the impact of such a reconstitution under Section 9B or under Section 45(4)? Of course, 45(4) will not come. You have already answered this question also.
So 9B also will not come because there is
will not come into play. Then comes another question, which is from Abhimanyu Singh. This is a question. Say A and B reconstitutes a firm having 50% share each. C decides to join the firm with 50% share in firm, for which he pays 30 lakh to the partnership firm for getting 50% share in the profit from partnership firm. This 30 lakh rupees received from incoming partner is to credit to the existing partner A and B in equal proportion. That is 15 lakh each. Will it cost 45(4)? I don't think there no asset is transferred.
No, but here the larger question that I see, that when you credit this 15 lakhs to the accounts of both the partners, then in that situation, are you saying that the partner has transferred his partnership interest to that extent in lieu of 15 lakhs? So but therefore, a
partner is going out of the partnership part.
It may say we are not on 9B. I am not on 9B or not on 45(4). If you see, normally if a new partner comes in, the money that he brings in as his capital remains in the firm. It is not credited to the partners. But if the effect of crediting this to the partners, will it amount to saying that an existing partner has relinquished his interest in the partnership to the extent of, let us say, 25% to the incoming partner in lieu of receipt of 15 lakhs, in which case it will be transferred under 247 read with 45 by the partner.
Yes.
So therefore, Not
But
the
9B will not come into
no,
play.
no, not 9B,
9B will not come into play.
not 9B, not 45(4). But it
Yes.
can be tax
Yes,
in the
yes.
hand of the partner under 45.
Yeah, that is true. That is
Right.
true. That is true. Next question. These are the questions, very interesting questions and very interesting subject, and you have dealt with it so beautifully. I think it's the most complicated section, particularly substituted section 45(4).
Right.
And to make it so simple and explain it to the audience so beautifully, and to receive so many questions on the chat box pursuant to the lecture, goes to the credit of the speaker, that he has been able to explain his subject so beautifully to his audience. So I really compliment you for giving such a wonderful deliberation on a very complicated subject today. We are really very enriched with your deliberation today. So with these, I hand over the mic back to Siddhartho. If any further questions are there from the audience, that can be addressed to Vohra Sahab and for further proceeding.
Will there be any more questions? If not, we would like to wind up today's session. What a wonderful session it had been. Ajay ji, as always, he was the interactions, the questions that came up, as Tulshanji told, he creates that interest and he creates that inclination towards asking things, getting into the subject matter so deeply. Wonderfully explained, sir. We are really thankful to you at the very onset. Let me thank you on behalf of the two organizations, the Income Tax Bar Association and the Tax Advocates Association of Bengal, to once again give us such an enlightening speech. We would also like to thank Shri Tulsianji for moderating the show and making all these things possible, connecting us with Shri Vohra. I would like to thank both the organizations, the president, office bearers, and the committee members of Tax Advocates Association of Bengal and Income Tax Bar Association for bringing us together in such a platform where we could congregate and listen to such a wonderful session. And last but not the least, thank you all the participants, all the members, dignitaries from all other associations, general members of the organizations. Thank you so much, and let's have a great time ahead. Very good evening to all of you, and with this, with the permission of the chair and the host president, Shri Makun Chandra Haldar, may we call this meeting off and end this meeting?
Hello.
Yes, Mr. Rai.
Before concluding this session, I want to put one question to
Please
London
go
Speaker,
ahead, sir.
sir.
Please go ahead.
I want to know whether the definition of Section 247 is required to be amended in order to give effect of Section 9B and Section 45(4), because the definition of Section 247 relates to transfer of capital asset, because the transfer of capital asset on reconstitution of farm or dissolution of farm has not yet been included in Section 247. That is my question. Whether to give effect of these two sections, whether amendment of Section 247 is required or not.
Sir, here basically there is no dispute that 9B and 45(4) will trigger when there is distribution of the capital asset to the outgoing partner. So the ownership of the asset is changing hands. The legal entity is changing from the partnership to the individual partner. So to that extent, there is a transfer in law. There is a transfer, call it sale, call it exchange, whatever you want to call it. There is transfer of the capital asset from the firm to the individual partner. So it is within the existing definition of 247. It does not require an amendment to law. Although under general law, the partnership is not treated as a legal entity. It's a compendious name given to the partners. But for purposes of the Income Tax Act, it is an assessable entity.
Yes.
So and 9B treats it as a deemed transfer.
Okay.
Thank you, Mr. Rai. Sir, this proves ye dil mange more, even if we are trying to conclude the session, but this was so wonderful. We would definitely like to have you again addressing us. And on that note, we would like to conclude today with the permission of the chair. Mr. Haldar, can we conclude the meeting? I think silence is positive,
Yes,
so we can
yes,
go ahead.
yes,
Yeah.
yes, yes.
Thank you very
Yes.
much, and we would like to meet you again on this platform. All of you stay blessed, stay well, stay safe. Thank you.
Thank you. Thank you.